Good evening, and welcome to AI and Finance Insider. This is your U.S. financial markets update. U.S. financial markets are entering February with renewed momentum as major stock indices move higher following weeks of volatility. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite have all posted gains supported by corporate earnings reports and stabilizing investor sentiment. Market participants are responding to stronger than expected earnings, easing concerns around bond yields, and continued optimism surrounding productivity gains driven by artificial intelligence. However, analysts note that this recovery remains uneven. Technology and AI-related sectors are leading the advance, while several traditional industries continue to show slower growth. Artificial intelligence remains a central theme shaping market behavior across the United States. Companies connected to cloud computing, data centers, and advanced semiconductor manufacturing remain under close scrutiny from investors. Recent market activity suggests a transition away from speculative enthusiasm and toward deeper evaluation of revenue growth, capital investment, and long-term profitability related to AI adoption. As earnings season continues, artificial intelligence is being mentioned frequently in corporate earnings calls across multiple sectors. Executives are highlighting automation, operational efficiency, and long-term productivity improvements. Markets, however, are rewarding execution rather than promises. Companies unable to demonstrate measurable financial results from AI investments are seeing limited positive market reaction. Turning to commodities, U.S. markets are showing increased volatility. Gold and silver prices have rebounded after recent declines, reflecting renewed interest in defensive assets. These movements are being driven by changes in interest rate expectations, fluctuations in the U.S. dollar, and persistent geopolitical uncertainty. Despite rising equity markets, demand for precious metals suggests investors remain cautious. In bond markets, U.S. Treasury yields continue to play a key role in equity valuation. Higher yields place pressure on growth-oriented stocks, particularly within technology and AI-focused industries. Recent stabilization in yields has provided short-term relief, contributing to the latest rebound in equity prices. Global economic developments are also influencing U.S. market sentiment. Trade discussions and tariff adjustments between major economies are impacting multinational earnings expectations, currency markets, and global capital flows. For U.S. investors, these developments highlight the interconnectedness of today's financial system. Beyond financial markets, artificial intelligence is also reshaping how financial information is produced and consumed. Digital platforms, including YouTube, have recently reinforced policies aimed at reducing misleading and low-quality AI-generated financial content. These changes place greater emphasis on accuracy, transparency, and educational value for viewers. Taken together, current market conditions reflect a balance between optimism and caution. U.S. equities are advancing, artificial intelligence remains a dominant long-term theme, and commodities signal ongoing uncertainty beneath the surface. Rather than pointing to a single outcome, these trends emphasize the importance of informed analysis and disciplined research. Looking ahead, artificial intelligence is increasingly viewed as a structural force within the U.S. economy. Its influence extends across productivity growth, corporate investment decisions, and competitive dynamics in nearly every major industry. As February progresses, markets will remain sensitive to upcoming economic data, Federal Reserve communication, and forward guidance from U.S. corporations. You have been watching AI and Finance Insider. For continued coverage of U.S. markets, artificial intelligence, and financial trends, consider subscribing to the channel. Thank you for watching, and we'll see you in the next update.